Hello everyone, welcome to the 203rd episode of me learning how to trade in Forex. So in the last episode, we went through the second bit of this how to start Forex trading and beginner's guide with Forex trading strategy and education, with Forex trading and beginner's guide. Jesus, okay, so we went through this first bit. So foreign exchange trading involves buying one currency, selling with the other. Yep. Basically, FX market is a global marketplace for exchanging national currencies. Because of the worldwide reach of the trade, commerce and finance, Forex markets combine to be the world's largest and most liquid asset markets. Currencies trade against each other as exchange rate pairs. For example, Euro-USD is a currencies pair for trading the Euro against the USD. Forex markets exist as spot, cash, and derivative markets offering forwards, futures, options, and currency swaps. Some market participants use Forex to hedge against international currency and interest rate risk, speculate on geopolitical events, and diversify portfolios, among other reasons. So, what is a Forex market? Forex market is where currencies are traded. So no central marketplace, currency trading is done electronically over the counter, all transactions occur via computer networks among traders worldwide. Main markets open 24 hours a day, 5 days a week. Where does the Forex market work? How does a Forex market work? Continuous 24 hours a day during weekdays trading market in the world. So trade investors of all sizes participate in it. So newer traders in the market, okay, never mind, ignore that bit. Newer traders in the market have helped lure in fraudsters looking to take advantage of less knowledgeable investors. Where is it? No physical buildings, series of connected trading terminals and computer networks. Who trades on it? Most currency traders were large multinational corporations, hedge funds, or high net worth individuals because Forex trading requires a lot of capital. So commercial investment banks still conduct most of the trading in Forex markets on behalf of their clients. However, there are also prospects for professionals and individual investors to trade one currency against the other. What is Forex trading? Capturing the changing values of pairs of currencies. So Forex trading is also used for hedging purposes. Individuals and businesses use Forex trading to protect themselves from unfavorable currency movements. So by securing a favourable rate in advance through Forex trades, a firm can reduce financial uncertainty and ensure more stable costs in its domestic currency, which is an essential part of international business today. So Forex trading has high liquidity, meaning it's easy to buy and sell many currencies without significantly changing their value. In addition, traders can use leverage to amplify the power of their trades, controlling a significant position with a relatively small amount of money. However, leverage is also a double-edged sword, so amplify losses as well. I just remembered, this is the bit where we got off to in the last episode. So the bit we went through in the last episode actually starts from here. So how to start trading Forex. Learn about Forex, develop a trading strategy, develop a plan, set up a brokerage account, practice with demo accounts, start slowly, stay on top of your holdings, and monitor and adapt. So type of markets, 3 types of markets: forwards, spot, forwards, and future markets. Spot markets, currencies are bought and sold at their trading price, and prices are determined by the supply and demand and reactions to specific factors such as interest rates, economic performance, geopolitical events, and price speculation. So finished deal on a spot market is known as a spot deal. Forwards and futures markets. Forward contract is a private agreement to buy a currency at a future date and a predetermined price in the over-the-counter markets. A futures contract involves the same principle but are standardized. Futures trade on exchanges, not over the counter. So in the futures markets, futures contracts are bought and sold based on a standard size and settlement date on public commodities markets such as the Chicago Mercantile Exchange. Futures contracts have specific details, including the number of units being traded, delivery and settlement dates, and minimum price increments that can't be customized. The exchange acts as a counterparty to the trader, providing clearance and settlement services. So both types of contracts are binding and are typically settled in cash at expiry, although their contracts can be also bought and sold before they expire. So also options contract, trade on a specific currency pair, so it gives the holder the right but not the obligation to buy or sell a currency pair at a specified price on a specified date. So using the Forex markets, two features of currencies as asset class can earn the interest rate differential between the two currencies, or can profit from the changes in the exchange rate. So Forex for hedging. Foreign exchange markets provide a way to hedge currency risk by fixing a rate at which the transaction will be completed. And then Forex for speculation. So interest rate trade, political stability, economic strength, and geopolitical risk all affect the supply and demand for currencies. So this creates prospect for profiting from changes that may increase or reduce one currency's value against another. So, yep. Basic Forex trading strategies. So, different types of trading strategies. Most basic trades are long and short. So, going long, the trader bets that the currency price will increase, they can profit from it. Short trades consist of a bet that currency's pair's price will decrease, and they also profit from it. Depending on the duration and number of trades, there's 4 types of main trading strategies: scalping, day trading, swing trading, and position trading. Then looked at the Forex terminology, so what each term means. Charts used in Forex trading: line charts, bar charts, and candlestick charts. Pros and cons of Forex trading, with each of these factors explained. The difference between trading and investing. So trading involves a short-term approach, whereas investing is more of a long-term approach. Forex scams, frauds, and hucksters. So different types of notable scams in Forex trading. What to look out for the common types of scams: so signal seller, high-yielding investment programs, fake brokers, and automated trading systems. And some tips to avoid Forex scams. So verify broker credentials. Tips to avoid Forex scams. So verify broker credentials. Verify broker credentials. Be skeptical of high returns. Be skeptical of high returns. Do your research and use security tools. So verify broker credentials. Ensure the broker is registered with a reputable regulatory body. Ensure the broker is registered with reputable regulatory bodies, like the CFTC or FCA. Check their regulatory status and history of compliance. There are just 6 CFTC registered Forex dealers in the US. Avoid trading with any others. Check their regulatory status. And history of compliance. So 6 CFTC registered Forex dealers in the US. I forgot what CFTC stands for, but I know that FCA is the Financial Conduct Authority, I think. So be skeptical of high returns. Avoid investment products that promise guaranteed high returns with little or no risk. So avoid investment products that promise guaranteed high returns with little or no risk. Legitimate investment always have risk. Legitimate investment always have risk. And reputable brokers front the risk for you to ensure you understand what you're getting into. Do your research, investigate the company, its management team and its track record. So investigate the company, its management team and its track record. Look for reviews and testimonials from credible sources. Look for reviews and testimonials from credible sources. Be aware of common scam tactics like fake accounts, impersonations and misleading marketing materials. And choose broker with transparent fee structures, clearly defining trading conditions and accessible customer support. So choose brokers with transparent fee structures. Clearly defined trading conditions and accessible customer support. Use security tools, employ VPNs, passwords managers and antivirus software to protect your trading accounts and personal information. Forex fraud will likely become more innovative as markets evolve and sophisticated technology tools enable ever more complex con jobs. But with consistent vigilance, robust regulation and security and prudence, Forex trading can be navigated more securely. So that's where we left off at last episode. Now on to how much money do I need to start trading Forex. So you can start trading Forex with as little as $1,000 funded into a micro account. But we'll need significant more capital for a standard account. Standard's like 100k, isn't it? Leverage from brokers can allow you to trade much larger amounts than your account balance. Brokers may provide capital at a predetermined ratio, for example, such as putting up $50 for every $1 you put up for trading. This means you may only need to use $10 from your own funds to trade $500 in currency. The specific minimum deposit will depend on the brokerage you use and the amount of leverage they allow. Are Forex markets volatile? Forex markets are among the most liquid markets in the world, so they can be less volatile than other markets such as stocks. The volatility of a particular currency is a function of multiple factors such as the politics and the economics of its country. Therefore, events like economic instability in the form of a payment default or imbalance in trading relationships with another currency can result in significant volatility. Are Forex markets regulated? Forex trade regulation depends on the jurisdiction. Countries like the United States have sophisticated infrastructure and markets for Forex trades. Forex trades are tightly regulated in the US by the National Futures Association and the CFTC. However, due to the heavy use of leverage in Forex trades, developing countries like India and China have restrictions on the firms and capital to be used in Forex trading. Europe is the largest market for Forex trades. The Financial Conduct Authority monitors and regulates Forex trades in the United Kingdom. So the Financial Conduct Authority. Which currencies can I trade in? Currencies with high liquidity have a ready market and exhibit smooth and predictable price action in response to external events. The US dollar is the most traded currency in the world. It is paired up in 9 of the world's 10 most traded currency pairs. Currencies with low liquidity, however, cannot be traded in large lot sizes without significant market movement being associated with the price. The bottom line, Forex trading offers the potential for significant profits but also carries substantial risks. The foreign exchange market's vast size, liquidity and the 24/5 accessibility makes it attractive to traders worldwide. However, the inherent volatility, leverage, and complexity of Forex trading can quickly lead to significant losses, especially for inexperienced traders. To succeed in Forex trading, you must develop a deep knowledge of these markets, economic fundamentals, and technical analysis. Managing a risk is essential, including proper position sizing and stop losses. Traders should also remain vigilant against the many frauds that pervade the Forex market. Aspiring Forex traders should start with a solid education, practice with demo accounts, and only risk capital they can afford to lose. Partnering with a reputable, well-regulated broker and maintaining realistic expectations are also crucial. Managing risk is essential, which includes proper position sizing and stopping losses. To succeed in Forex trading. Aspiring Forex traders should start with a solid education, practice with demo accounts. New Forex traders should start with a solid education, practice with demo accounts, and only risk capital they can afford to lose. Partnering with a reputable, well-regulated broker and maintaining realistic expectations are also critical. Maintaining realistic expectations. Use a reputable and well-regulated broker. Maintain realistic expectations. Maintain realistic expectations. Also crucial. Okay, that's done. So, basics of currency trade. No, next up, getting started in Forex. Investopedia. Getting started in 07/2024. Cool. Getting started in Forex. So, the Forex FX market has many similarities to the equity markets, so the stock markets. However, there are also some key differences. This article will show you these differences and help you get started in Forex trading. If you've decided to take a stab at Forex trading, the good news is that access to the currency markets has never been easier. A wide range of online brokerage platforms offer everything from spot trading to futures and CFDs. Key takeaways. To settle on a Forex deal broker, do your due diligence and make sure you choose the one who can meet your trading needs now and over time. Look for low spreads and fees from a provider in a well-regulated jurisdiction. Compare the types of trading platform, trading and analysis tools, access to leverage and more. Before trading, study basic Forex strategies and learn how to analyze currency markets properly. Consider starting with a demo account to try out and backtest your strategy before risking real money in the market. So choose a Forex broker. There are many Forex brokers to choose from. Here are some things to look for in a Forex broker. Look for lower spread. Factors to look for in a Forex broker. Look for lower spreads. The spread calculated in pips is the difference between the price at which a currency can be purchased and the price at which it can be sold at any given point in time. Price changes are described in terms of pips, ticks, and points. A high spread indicates a big difference between the prices for buying and selling. A low spread indicates a narrow difference. Forex brokers don't usually usually don't charge commission, instead they make their money on the spread. So look for a lower spread. When comparing Forex brokers, you may find a large range of spreads. Okay, choose a broker who's backed by regulatory agencies and a reliable institution. Unlike equity brokers, Forex brokers are usually tied to large banks or lending institutions because of the large amounts of capital required, leverage that they need to provide. So, choose a broker who's backed by regulatory agencies and a reliable institution. Unlike equity brokers, Forex brokers usually tied to large banks or lending institutions because of the large amounts of capital required, leverage that they need to provide. Forex brokers are usually tied to large banks or lending institutions due to the leverage they may need to provide. Also, a Forex broker should be registered as a futures commission merchant and regulated by the Commodity Futures Trading Commission, or there we go, CFTC. You can check on this and other financial information and statistics at a Forex brokerage website, the website of its parent company, or through BrokerCheck at the Financial Industry Regulatory Authority website. Get the tools you need to succeed. Forex brokers offer different trading platforms for use by their clients. Just like brokers in other markets, these trading platforms usually feature real-time charts, technical analysis tools, real-time news and data, and even support for the trading systems. As part of your broker selection process, be sure to request free trials to test the different trading platforms. Brokers also provide technical and fundamental information, economic calendars, and other extensive research. Get the tools you need to succeed. Request free trials to test the different trading platforms. Brokers also provide technical and fundamental information, economic calendars, and other extensive research. Leverage your bets. Leverage is necessary in Forex because the price deviations to sources of profit are merely fractions of a percent. Give leverage some thought. Yeah, I don't think this one is right, to be honest, because as a new trader, you don't really want to rely on leverage that much. So I wouldn't write this one down, to be honest. Leverage your bets. Leverage is necessary in Forex because the price deviations to sources of profit are merely fractions of a cent. Leverage, expressed as a ratio between total capital available to the actual capital, is the amount of money a broker will lend you for trading. For example, a ratio of 100 to 1 means a broker would lend you $100 for every $1 of actual capital. Many brokerages offer a ratio of 250 to 1. 250 to 1. So give leverages some thought. Bear in mind that while less leverage means lower risk of a margin call, it also means less bang for your buck. Important, if you have limited capital, consider a brokerage that offers high leverage through a margin account. If you have plenty of capital, any broker with a wide variety of leverage options should do. A variety of options lets you vary the amount of risk you're willing to take. For example, less leverage and therefore less risk may be preferable for high volatile exotic currency pairs. If you have limited capital, consider a brokerage that offers high leverage through a margin account. Oof. That's dangerous, that is. Yeah, nah. So choose a broker with appropriate leverage tools and services for your capital. Many brokers offer two or more types of accounts. The smallest account is known as a mini account, requires to trade with a minimum of say $250, and that offers a high amount of leverage, which you need in order to make money with this size of the initial capital. Because it's too few, right? The standard account lets you use different degrees of leverage but has an account minimum of $2,000. Premium accounts, which often require significantly higher amounts of capital, lets you use different amounts of leverage and often offer additional tools and services. Premium accounts. Choose a broker with appropriate leverage, tools and services for your capital. So choose a broker with appropriate leverage, tools and services for your capital. Forex broker actions to avoid: sniping and hunting. Sniping and hunting are the premature buying or selling of currency near preset points. They are inappropriate activities used to increase profits. The only way to determine the brokers that do this is to talk to fellow traders. There is no blacklist organization that reports such activity. Sniping and hunting. Sniping and hunting are the premature buying or selling of currency near preset points. They are inappropriate activities used to increase profits. What does that mean? Sniping and hunting are the premature buying and selling of currency near preset points. Forex broker actions to avoid: sniping and hunting. The premature buying or selling of currency near preset points. The premature buying or selling of currency near preset points. They are inappropriate activities used to increase profits. They are inappropriate activities used to increase profits. The only way to determine the brokers that do this is to talk to fellow traders. There is no blacklist organization that reports such activity. The only way to determine that brokers do this, the only to determine the brokers that do this is talking to fellow traders. There's no blacklist organization that reports such activity. Suspect margin rules. When you are trading with borrowed money, your forex broker has a say in how much risk you can take. As such, your broker can buy or sell at their discretion, which can affect you negatively. Can buy or sell at their discretion. Let's say you have a margin account and your position suffers a sudden drop before rebounding to an all-time highs. Even if you have enough cash to cover the change value, some brokers will liquidate your position on a margin at the low. Their action can cost you a significant amount of capital. Be sure to conduct thorough due diligence prior to selecting a broker. Once you've made your selection, signing up for a Forex account is similar to getting an equity account. The only major difference is that for Forex broker accounts, you are required to sign a margin agreement. This agreement states that you will be trading with borrowed money, and as such, the brokerage has the right to intervene in your trades to protect its interests. That said, once you sign up and fund your account, you'll be ready to trade. Can buy or sell at their discretion, which can affect you negatively. So, suspect margin rules. Suspect margin rules. So this only happens if you're using leverage, right? So if you're not using leverage, then the broker won't have a say in how you trade. When trading with borrowed money, your forex broker has a say in how much risk you take. Your forex broker has a say in how much risk you can take. As such, your broker can buy or sell at their discretion. So your broker can buy or sell at their discretion, which can negatively affect you. Let's say if a margin account and your position suffers a sudden drop before rebounding to all-time highs. So that sudden drop could be something your broker's done. Even if you have enough cash to cover the change in value, some brokers will liquidate your position on a margin call at the low. Their action can cost you a significant amount of capital. Be sure to conduct thorough due diligence prior to selecting a broker. Once you've made your selection, signing up for a Forex account is similar to getting an equity account. The only major difference is that for Forex accounts you're required to sign a margin agreement. This agreement states that you'll be trading with borrowed money, and as such, the brokerage has the right to intervene in your trades to protect its interests. That said, once you sign up to fund your account, you'll be ready to trade. When signing up for a Forex account, you are required to sign a margin agreement, which states you'll be trading with borrowed money, and so the broker has the right to intervene in your trades to protect its interests. Okay, define your method of analysis. Technical analysis and fundamental analysis are two different methods used by Forex traders to help them determine when to enter and exit the Forex market. Technical analysis is by far the most commonly used. Fundamental analysis. If you think it's difficult to value one company, try valuing a whole country. Fundamental analysis in the Forex market is very complex. It's often used only to predict long-term trends. However, some traders do trade short-term strictly on news releases. Fundamental indicators of currency values are released at different times. These include non-farm payrolls, Purchasing Managers Index, Consumer Price Index, Retail Sales, and Durable Goods. Oh, I didn't realise you could click on the mini number up there. Oh, right, okay, so try valuing. So fundamental indicators of currency values are released at different times. Which include fundamental indicators of currency values such as non-farm payrolls, Purchasing Managers Index, Consumer Price Index, Retail Sales, and Durable Goods are released at different times. These reports are not the only economic announcements to watch. News coverage of and press releases from relevant government agency meetings can also move markets. For example, the Federal Reserve's chair's comments on interest rates can cause market volatility. So news releases and press releases from relevant government agency meetings can also move markets. For example, the Federal Reserve Chair's comments on interest rates can cause market volatility. So these regular gatherings involve discussion of monetary policy, interest rates, inflation, other issues that affect currency valuations. Therefore, it's important that Forex traders be aware of the various economic reports to Congress, including those made by the Federal Open Market Committee and the Humphrey-Hawkins report. Okay, this is a new thing, Humphrey-Hawkins report. So it's important to be aware of the various economic reports to Congress. Of the various economic reports, such as those made by the Federal Open Market Committee and the Humphrey-Hawkins report and the Humphrey-Hawkins report. Reading the reports and examining the commentary can help Forex fundamental analysts gain a better understanding of long-term market trends. Reading the reports and examining the commentary can help Forex fundamental analysts can't say that, gain a better understanding of long-term market trends. Short-term traders may learn to profit from extraordinary events. If you choose to use fundamental analysis, be sure to keep an economic calendar handy at all times so you know when these reports are released. Your trading platform or broker may also give you real-time access to the release of the economic data. So keep an economic calendar. Keep an economic calendar handy at all times to know when economic reports are released. So you know when these are released. Your trading platform or broker may also give you real-time access to the release of economic data. Technical analysis. Forex technical analysis analyze price trends. Similar to their counterparts in the equity markets, the key difference between technical analysis in Forex and in equities is time frame. Forex markets are open 24 hours a day. As a result, certain technical analysis tools that factor in time must be modified for the 24-hour period. Here are some of the most common forms of technical analysis used in Forex. The Elliott waves. I think I've heard of that. Fibonacci studies, yep. Parabolic SAR and pivot points, yep. Many technical analysts combine these studies to make more accurate predictions, e.g. the common practice of combining Fibonacci studies with Elliott waves. Others create trading systems to repeatedly locate similar buying and selling conditions. So looking at what happened in the past, and then if that same scenario happens again, then doing exactly what the same thing happened in the past to make a profit. Develop your Forex trading strategy. Most successful traders develop a strategy and perfect it over time. Some focus on one particular study or calculation, while others use broad spectrum analysis to determine their trades. Experts suggest trying a combination of both fundamental and technical analysis in order to make long-term projections and determine short-term entry and exit points. That said, individual traders must decide what works best for them, often through trial and error. Right. So added considerations, open a demo account and paper trade until you can make consistent profit. Yep. Smart, open a demo account until you can make consistent profit. Paper trade just paper trade is simulated that allows without risking real money. Yep. So until you can make consistent profits, many people jump into the Forex market and quickly lose a lot of money due to taking on too much leverage. It is important to take your time and learn to trade properly before committing capital. Trade without emotion. So trade without emotion. Avoid mental stop loss points if you don't have the ability to execute them on time. Mental stop loss points. Always set your stop loss and take profit points to execute automatically. Don't change them unless absolutely necessary. The trend can be your friend. If you go against the trend, make sure you have a good reason. That's because you have a higher chance of success when trading with the general trend of the Forex markets. The trends can be your friends. Avoid mental stop loss if you don't have the ability to execute them on time. Always set your stop loss and take profit points to execute automatically. Don't change them unless absolutely necessary. If you go against the trend, make sure you have a good reason. That's because you have a higher chance of success when trading with the general trend of the Forex market. Cool, what is Forex trading? Which I'm going to leave in the next video. So, thank you all for watching. In the next video, we're going to carry on with this getting started in Forex with what is Forex trading. See you guys then. Peace.